Oil prices extended gains on Friday, but they are headed for their first weekly loss in 3 weeks. Investors are concerned that rising inflation and China's COVID lockdowns are slowing global growth. Supply concerns have eased for now as the prospects of the EU quickly ending purchases of Russian fuel are dimming. EU officials say many importers of natural gas have already set up ruble accounts with Gazprom to circumvent financial restrictions on Russian banks. Brussels is instead devising a longer-term plan to phase out Russian fuels by 2030. On this, let's go to David Madden in London. He is a market analyst at Equiti Capital. Many thanks for being with us today. First of all, the idea of pushing off the move against Russian oil, which Hungary has said would be too damaging to its economy, is gaining support, diplomats have said. But some say removing it now would be a sign of weakness. What is your feeling about all this?
I think indeed removing it entirely would be a sign of weakness. The EU are really keen to distance itself from Russia, understandably, and they're looking to kind of phase out the importation of Russian oil over the next 6 months. But we have a couple of EU members, Slovakia and Hungary, who are strongly opposed to this, partially because, largely all down to the fact that their economies are heavily dependent on available and cheap Russian oil. So it's no surprise that they're balking at this possibility. In the last few days, we've already heard the prospect of both Slovakia and Hungary being made exempt from this proposed embargo. So I think if we do have any kind of progress in relation to this planned embargo, I think it is going to be a situation where certain member states may choose to opt out, possibly with the view to committing to a longer-term plan, taking both Hungary and Slovakia off Russian oil, perhaps in the longer term.
Right, David, we've seen really a whole host of factors having an impact on oil prices and pushing and pulling it in different directions. Chinese lockdowns, but also a slowing global demand. How much further do you really expect oil prices to rise?
I think oil prices are going to remain, to be honest, in around the current level that they're at. Brent crude oil is around $107 a barrel. In the last week or 10 days, when we first heard about this proposed EU embargo on Russian oil, we saw Brent crude up around $115 a barrel. It wasn't a total surprise that the EU were going to come out with that statement. But now we're obviously seeing the division within the European Union. As I mentioned, a couple of member states are opposed to such a ban on Russian oil. That means, and the wider context, there's concerns about the global economy. We recently heard from the Bank of England last week, who predict the UK economy will contract next year. There's talks that Germany is already in recession. We saw negative growth in the first quarter of the US. Various organizations, the World Bank, the IMF, have downgraded global growth forecasts. So we have seen kind of a change in overall global outlook. Only yesterday, we saw the price of copper fall to an 8-month low. So this is really indicative of the negative sentiment or the negative outlook that traders and investors have. That being said, oil is holding up in around $105, $107 a barrel for Brent crude oil. And that's more to do with squeezed supply rather than actually robust demand. And the likes of OPEC and other Middle Eastern oil-producing nations don't seem to be in any great rush to get back to the kind of pre-crisis levels of production.
David Madden, many thanks for this update.